What if the most famous financial crash in history was mostly a myth? And what if the exact same human pattern that inflated tulip prices in 1637 is still running markets today? Most people think bubbles are pure madness, greed, irrationality. The data tells a different story. Some bubbles barely dented the economy, others nearly broke the world. Here's how the biggest ones actually unfolded. Start with Tulip Mania, 1630s Netherlands. The legend says ordinary people sold houses and businesses for flower bulbs. One rare tulip, the Semper Augustus, supposedly cost more than a luxury home. Then the market collapsed and the Dutch economy was ruined. Here's the twist. Modern historians dug into the actual records. The frenzy was real, but narrow. Mostly merchants and craftsmen trading futures on rare, broken tulips. Prices did go insane for a few months. Then in February 1637, buyers simply stopped showing up. The wider Dutch economy barely noticed. No depression, no mass bankruptcies. The country stayed one of the richest in the world for decades. The dramatic version we all know mostly comes from an 1841 book that exaggerated everything. Tulip Mania was a real bubble. It just wasn't the civilization-ending event people still claim. Now jump to 1720. Two bubbles explode at the same time. In Britain, the South Sea Company. It had a monopoly on trade with Spanish South America and the right to take over a huge chunk of government debt. The stock went from around £100 to over £1,000 in months. Directors bought their own shares with company money. Politicians got bribes. Everyone piled in. Then the trade profits never appeared. Confidence vanished. By December, the stock was back, near £124. Thousands of investors were wiped out. Same year in France, John Law's Mississippi Company. Shares started around 500 livres and rocketed to roughly 10,000. Law basically took control of French public finance and paper money. People believed colonial riches would make them rich forever. When reality hit, the shares collapsed. Law fled the country. Two different countries, same year. Same core idea: turn government debt into company stock and sell a dream of future wealth. Both left political scars. Neither destroyed their national economies the way later crashes would. Fast forward to America in the 1920s, real growth was happening. New industries, rising living standards. But something else was happening too: easy margin buying. People could control large amounts of stock with very little of their own money. The Dow climbed from 63 in 1921 to a peak of 381 in September 1929. Even as some industries were already slowing, the optimism held. Then, the selling started. Black Thursday, Black Monday, Black Tuesday. In a matter of days, the market lost roughly a quarter of its value. The decline kept going. By summer 1932, the Dow had fallen almost 90% from the top. Was the crash the single cause of the Great Depression? No. Deeper problems already existed, but the collapse destroyed paper wealth, shattered confidence, and accelerated the downward spiral. Banks failed. Credit froze. The human cost was massive. This time, the speculation wasn't limited to a few rare bulbs or one company. It was woven into the entire financial system through leverage. Which brings us to 2008. This one looked different on the surface. It was houses, low interest rates, the belief that home prices only go up. Lenders pushed mortgages to people with weaker credit. Those loans got packaged into complex securities and sold around the world. The whole system was loaded with leverage. When house prices stopped rising and then fell, defaults climbed. The securities collapsed in value. Institutions that borrowed heavily against them faced sudden losses. March 2008. Bear Stearns forced into a fire sale. September. Lehman Brothers fails. Credit markets freeze. The crisis goes global. Governments and central banks intervene on a scale not seen since the 1930s. Unlike Tulip Mania, this wasn't contained. Housing sat at the center of household wealth and the banking system. When it cracked, the damage spread everywhere. Two more that still matter. Late 1980s Japan. Stocks and real estate both went vertical. At one point, the land under the Imperial Palace in Tokyo was valued higher than the entire state of California. When the bubble burst, Japan entered years of stagnation, weak banks, and deflation. And the late 1990s dot-com boom. The internet was real and transformative. But for a while, almost any company with .com in the name was treated like a guaranteed winner. The Nasdaq rose more than fivefold, peaked in March 2000, then fell nearly 78%. Many startups vanished. Some of the survivors later became the most valuable companies on Earth. The technology was genuine. The valuations, for a stretch, were not. So, what actually connects all of these? A few patterns keep showing up. A new story that seems to justify higher prices. Expanding credit and leverage. The greater fool mindset. Stop asking what something is worth and start asking only whether someone else will pay more tomorrow. And the belief that this time is different. The damage depends on how deeply the speculation is tied to the wider system. Narrow manias can deflate with limited fallout. Heavy leverage across banks and households can transmit pain everywhere. History doesn't repeat exactly, but the incentives and the psychology rhyme more than we like to admit. 4 centuries of bubbles. Some exaggerated into legends. Some powerful enough to reshape economies. The real lesson isn't that markets are pure casinos. It's that compelling stories, easy money, and human psychology can push prices far beyond sustainable levels. When that happens on a large enough scale, the correction is rarely gentle. Which of these crashes do you think is the most misunderstood? Drop it in the comments. And if you want more data-driven breakdowns of the forces that actually move markets, hit subscribe and check out the links in the description. Thank you and see you on the next one.